Ethereum is at a critical crossroads right now. We have seen a massive rally in the last weeks, driven by the Ethereum treasury companies and by the ETFs. But the purchases are slowing down. It seems like both of those entities have stopped buying. The question is, where does this leave Ethereum? Are we going to see a future appreciation, or will things come back down? We're going to look at data most people aren't considering. We're going to look at relative valuation data. We're going to look at on-chain data. We're trying to figure out what's behind the current price movements. Now, here's what I'm talking about. This is the Ethereum dominance. How much of all of crypto is currently in Ethereum when we compare market cap? And this tends to trade in a range somewhere between 7% and 21%. And at around 14.5%, we saw turnarounds several times in the past. Once in August of 2020, once in June of 2022, and now just recently. And this is what I mean by the crossroads. Will this resistance hold and we're going back down? Or is Ethereum going to outperform the rest of crypto by more than 50% from here, thus hitting the elevated levels that we have seen multiple times in the past? Here's a similar but somewhat different chart. This is the Ethereum market cap relative to the Bitcoin market cap. We have bottomed at a very similar time, so in the middle of April of this year. This is when the treasury companies started buying ETH. But the major difference is that here the upside isn't just 50%, it's potentially almost 140%. Let's have a look at a few more relative valuation charts before we get into the on-chain data. So we compared Ethereum with Bitcoin. Let's have a look at the relative valuation to XRP, to BNB, and to Solana as well. Here's Ethereum relative to XRP. It's in the middle of the trading range. Here's Ethereum relative to BNB, rather on the lower end of the trading range. So BNB might be comparatively expensive. Here's Ethereum relative to Solana, giving the impression that Solana might also be topping out soon. And here, this is probably the most important of the charts. We've got Ethereum relative to the others market cap. Now, others just means all the altcoins that are not in the top 10. And this chart is very relevant because a lot of altcoins are highly correlated with Ethereum. Many alts get traded directly in liquidity pools with Ethereum. So when Ethereum goes up, those altcoins appreciate as well. And so really, this chart tells us a nice story when people rather swap into ETH or swap into the altcoins. Again, the rally started in the middle of April of this year. Ethereum outperformed the altcoins by more than 100%. And now we are turning around at a very similar level to what we saw just 3 months ago. And so calling for the drop of Ethereum dominance seems like quite far-fetched. But calling for a drop of Ethereum relative to the others market cap, that seems quite reasonable. We have been in this trading range for a long time, and this would imply Ethereum to underperform the alts by 45%. Now the question is, will this be Ethereum underperforming, or will this be the altcoins outperforming? Or in other words, are people going to take profit in ETH, or are people going to roll over their Ethereum profit into the altcoins? Are they going more risk on now? Let's extend this chart. What we've got here in white is the Ethereum market cap relative to the Bitcoin market cap. So in green, again, it's Ethereum relative to the altcoins. In white, it's Ethereum relative to Bitcoin. We can see that since this vertical line, Ethereum relative to Bitcoin and Ethereum relative to the altcoins moved in the same direction, as in it was Ethereum that dictated the moves. This was not necessarily the case before that vertical line, right? Over here, for example, we saw Ethereum underperform Bitcoin, but it did outperform the altcoins. So this here was Bitcoin's strength. This was not an Ethereum weakness, because Ethereum was stable versus the altcoins. But it seems like in the last 3 months or so, the charts move more and more in tandem with one another. So really, it's now in and outflows from Ethereum that dictate the Ethereum dominance. It's not necessarily inflows into the other assets. And so what's happening here? Why is Ethereum suddenly underperforming versus the alts and versus Bitcoin? I think there are 2 major reasons. The first reason is that the purchases by the treasury companies are slowing down. Yes, we still have Bitmain buying more and more Ethereum, but Tom Lee starts now to dominate the market. And so it becomes a bit less interesting for all the other companies to buy more Ethereum. In the last 2 weeks, we haven't seen many purchases anymore. Have a look at the ETF holdings of Ethereum. That also almost went sideways in the last month. There was a lot of hype again, which started in the middle of April of this year, but that hype is slowing down. And so when purchases are slowing down, people start to take profit after such a massive outperformance. Again, this was roughly 100% more performance than the rest of the crypto space. Now, don't get me wrong, I do believe that the Ethereum US dollar price has a good chance to rise further, but I'm not so sure if Ethereum will still outperform the rest of crypto from here. We're very close to a resistance, and while crypto as a whole might continue to expand, because this year this is the stablecoin market cap, it continues to go up, so money flows from the fiat system into the crypto system. While this is true and Ethereum will likely appreciate in US dollars, I'm not sure if it will still outperform the rest. Have a look, for example, at the total value locked of Ethereum. So how much capital is currently in Ethereum? It peaked in DeFi summer at around 100 billion. So that was in November of 2021. And now we are very close to that again. It seems like we still have growth of decentralized finance on Ethereum. But that's actually not necessarily true. It's the assets on Ethereum that recently appreciated. Have a look at the total value locked measured in Ethereum. That peaked in April of this year at a very similar level to where we peaked during DeFi summer as well. Since April of this year, the total value locked is actually coming down. So this is all just outside purchases. This is all just Wall Street propping up the price. This is not more usage of the blockchain. Usage is growing slower than the Ethereum price is. And that's not necessarily a good thing. I'm not saying that we have to sell all of our Ethereum, but I do think it makes sense after this massive rally to at least take some profit and to rebalance the portfolio. Move some into Solana, move some into Bitcoin, and potentially maybe even take some chips completely off the table and buy something like gold, right? Something that's not correlated to crypto, that's a hedge in case things really turn bearish. It doesn't look like this, money gets into the space, but still a little bit of a hedge is rarely a mistake. And nobody ever got poor taking profit. Besides all the medium and short-term price movements, it's also always interesting to see what happens long-term. What kind of assets can we actually hold over the years? Because once we know that, we know what to do during times of potential sell-off. I think, for example, that there's no question that Bitcoin long-term will appreciate in US dollars. Have a look at the percent of Bitcoin supply that has not moved in the last 5 years. This fraction tends to increase long-term over time. So there's less and less Bitcoin that's available for active trading. At the same time, we see more and more Bitcoin getting purchased by the treasury companies. And we've got the ETFs on top of that. So one might argue that roughly 30% of Bitcoin supply is in the diamond hands, or it's completely lost. At least net, this chart is unlikely going to go down significantly. We've got more than 5% in the hands of the treasury companies, and we've got roughly 7% of the supply held by the ETFs. So that means more than 40% of Bitcoin supply is in the hands of entities that tend to just stack away their Bitcoin over time. All of those curves tend to go up over time. They tend to not go down. And again, this reduces supply. This increases the value. Yes, there is Bitcoin mining of 0.83% per annum, but that mining is much slower compared to the rate of lost Bitcoin or of accumulated Bitcoin through the treasury companies or through the ETFs. And so this is where crypto and especially Bitcoin differentiates itself from other asset classes. For many other asset classes, we see as prices go up that it's mainly the short-term investor that wants to make a quick buck. But we can see with the Bitcoin rally from recently 16K to above 100K that it's the long-term holders that tend to just accumulate over time that are causing the rally. So that's what we want, right? We want that the people that buy an asset, they're not selling it anymore in the future, at least in aggregate. And this is, I believe, what we see with Bitcoin. And so I don't think it's a real question whether or not Bitcoin will appreciate in the future, especially versus the US dollar, because the US dollar has an expanding supply. It tends to grow by roughly 6.8% per annum. So this is USM2. This is official numbers by the Federal Reserve. If we look at the money supply in 1959 and compare this with the money supply today, within 60 years, the monetary base expanded by 77x, which is an annual growth of 6.8%, which, by the way, is the majority of the return of the stock market as well. Most of the stock market return is just monetary debasement. And so when Bitcoin becomes more and more rare over time because of those entities, and the fiat base grows more and more, then the most straightforward approach would be to simply use the same kind of investment tactics that we have for other asset classes, right? For the stock market, for example, we've got our savings plans, our 401ks, or for property, we've got our mortgage payments, where again, we pay in regularly with our cash flow. We can do the same for Bitcoin. For Bitcoin, it's typically called dollar cost averaging. So for example, if we buy $1,000 worth of BTC, and we do this for the long term, as we do with property and as we do with the stock market as well. If we just expand our time horizon to say 6 years, so beyond a cycle typically for Bitcoin, then it's extremely likely that over time we are outperforming classical investment approaches, because again, Bitcoin becomes more rare over time and it still gets more and more adoption. Had you followed this $1,000 per month approach with the S&P 500 or with gold, and you did this for 6 years, you'd be at somewhere around 120, 130K now. Had you done the same for Bitcoin, you'd now be at 360K. So roughly 3x the amount. And so this is where Bitcoin differentiates itself massively from the altcoin market. With the altcoins, we do not know what will be around still in 6 years, what will still be relevant in 6 years. The altcoins are highly inflationary, as in projects issue new tokens over time so that venture capitalists can sell their tokens, so that the team can sell their tokens. There are vesting unlocks. And when we look at the entire market, the entire altcoin market that's tracked here on Tokenomics AI, we've got unlocks of roughly 1 billion per week. So as long as we don't see 1 billion of purchases every single week in the altcoins, the prices of the altcoins are going down. Now, how much is 1 billion per week? Let's compare this with Bitcoin. Bitcoin has a market cap of 2.27 trillion and it's got an inflation rate of 0.83%, which by the way is debatable because again, we've got the purchases by all of those other entities and we've got the Bitcoin that gets lost. But let's ignore all of this. Let's just say this doesn't exist. Let's say we really have a net issuance of those 0.83% on the 2.27 trillion. If we run the numbers, we've got selling pressure of 371 million per week. So roughly a third of what the altcoins have as selling pressure. Now, how likely is it that the altcoins in aggregate get purchased at 3 times the rate of Bitcoin when Bitcoin already has this direct link to Wall Street? I think the likelihood is rather low. On top of that, the Bitcoin market cap is roughly 7 times the market cap of the altcoins. So the selling pressure is only 1/3. The market cap is 7 times as large. So really, relatively speaking, the altcoins have an inflation rate that's 20 times larger. And that's what's causing this situation. This is the smaller altcoins, the performance in the last year. Bitcoin has roughly doubled in the last year. And just have a look at how many altcoins that are shown here have doubled. There's 1, 2, 3 altcoins that did roughly the same as Bitcoin. There's only one outperformer. The rest all massively underperformed. And this is not a coincidence. This is simply just capital concentration towards the long-term winner in the market. You can't buy Quick or Myro or Pika or Atlas for $1,000 every month and just use this as another savings vehicle. Dollar cost averaging into those assets doesn't make sense, but dollar cost averaging into Bitcoin or Ethereum very much makes sense. And so I'm taking advantage of this capital concentration process. I'm betting on most altcoins doing worse than Bitcoin over time. And that's how I create additional alpha over just buying and holding Bitcoin. I don't just dollar cost average into Bitcoin, I dollar cost average into my trading portfolio, and I buy Bitcoin and Ethereum and Solana, and I sell or short sell all the bad altcoins over time. So this is my active trading portfolio measured in BTC. And of course, there is a lot of dollar cost averaging happening here as well. There's additional capital that enters this portfolio every month. But had I not dollar cost averaged at all, then because of my relative valuation trades, I still doubled the money. So without the relative valuation trades, my portfolio would now be only at around 2.5 Bitcoin instead of 5 Bitcoin. That's the kind of impact that's doable after 4 years of following such a strategy. So basically take this DCA approach and just 2x that capital. That's then 720k versus just having around 100k doing a traditional S&P 500 savings plan. Have a look at Arbitrum, for example. This is the number of ARB tokens over time that are circulating. When the supply expands and the demand doesn't expand at the same rate, then the price underperforms. Now, this is Arbitrum in US dollars, and this already doesn't look that great, right? We have seen Arbitrum going down by 60%. But compare Arbitrum relative to Bitcoin, it's much, much worse. Again, because Bitcoin has all of those inflows from traditional finance, and because a lot of Bitcoin gets lost over time, and because Bitcoin does not have this ultra aggressive supply schedule. The number of Arbitrum tokens is expanding faster even than the number of US dollars. And that's why it's losing even against the US dollar, but it's definitely losing against Bitcoin. And so my approach to generate alpha out of this is to just flip this chart around. So instead of looking at ARB relative to Bitcoin, here's Bitcoin relative to ARB. So you're going short Arbitrum, we're betting on falling prices of Arbitrum, we're betting on rising prices of Bitcoin. And what we see in orange, this is just the Bitcoin price during the same time. So we outperform buying and holding Bitcoin massively with that strategy. For example, over here, since the beginning of 2024 to today, Bitcoin has appreciated by 164%, but Bitcoin relative to Arbitrum has appreciated by 678%. Now, this is way higher than the alpha that I personally achieve, but of course, I'm also rather risk averse. I don't bet the entire portfolio on a single token, and not everything that inflates as aggressively tends to also lose that constantly. But again, it's all about the long term. It's about building wealth over several years, not just speculating on what's happening next week. Now, granted, betting on relative valuations, so something going up while the other thing is going down at the same time, is a bit more complex compared to just buying an altcoin straight out. But that's why I made dedicated videos on the topic. There's actually only two videos that you have to watch. So there is this one over here, using perpetual futures to bet on relative valuations. And there's this one over here, risk management with relative valuation bets. It's 1 hour in total worth of content, and after you've watched that, you know how to set up positions like this. Now, there are bets that are a bit more risky than others. Arbitrum is rather risky. Just have a look at this drawdown here. But there are also more constant winners. For example, have a look at this. This is Bitcoin relative to Balancer. Balancer, again, being a very inflationary token. Here's my offer. You watch those two videos, you learn how to set up those relative valuation trades and how to do the risk management properly. And then afterwards, after you've joined the community, I will send you my favorite trade. So I've got several of those relative valuation trades open, but I will send you my favorite one. And if you don't make money with that favorite trade after 1 month of holding that relative valuation trade, then I will just refund you the membership fee. So this video over here and this video over here. And if you don't make money with that favorite trade, you will get the $125 back. That's the fee per month. I, of course, share every single trade that I make. I don't just share my favorite trade. I share all the trades that I make in real time to the premium members. A link to premium should pop up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.